The S&P 500 is now on a 6-week winning streak. That is the longest in 4 years. And speaking of 4 years, that's how long presidents in the U.S. are in office. Next year will be Biden's last year in his 4-year term, and then he has to go to the polls. This is a look at how the S&P 500 does in each year of a presidency. And you can note the blue line, which is the average, tends to do well in that 4th year. Maybe by coincidence, maybe because there's a lot of incumbents that want to stay in office. And so you get a lot of sprinkling of market-friendly goodies that come out. And as you can see, during Biden's presidency has tracked pretty well what has gone on with the historical average. So we'll see what 2024 has in store. Our next guest is not so optimistic. He says the upcoming election year could be messy for U.S. markets. Bill Blaine is a market strategist at Shard Capital. Bill, why do you think that?
Well, next year is going to be particularly difficult to create these goodies that tend to drive the market higher and make it look more attractive, simply because the two sides of the U.S. House are simply not talking to each other, making it very difficult to move things. We've known that for a long time, so that's a given. But I think the real reason that's going to hold back markets next year is the fact we are now in a position where we have these higher interest rates, which have effectively been in place now for a year. The lagging effects of higher rates are only really going to start to be felt next year in the pockets of consumers, in corporates trying to borrow cash to repay their current borrowings, and also in governments where we have very high government debt quantums. And that's going to all result in more pressure towards downside for the economy. Now, perversely, I'm less worried about the States than I am about some of the other economies. If there was one stock market to pick, it would probably be the US. I think certainly these lagging effects on employment, on corporate defaults, and on government borrowing and what they can actually spend money on are going to be felt hardest in Europe.
And I was actually going to push back on the United States because, there's this thinking that rates are going to come down at some point next year, so you won't have to deal with the shock. And many people have been able to make themselves immune to it because of the way the housing market works in the U.S., right? If you're locked in 30 years, you don't have to deal with higher interest rates if you don't want to.
That's certainly true. And there's a lot of people who believe there is still an awful lot of slack in the economy in terms of the savings that consumers built up through the pandemic. But that's not what we're seeing in terms of the real numbers. They show that consumers have seen their savings spent and eaten up by inflation. But what I think one of the key issues that we need to look at in all markets is this lag in terms of when interest rates start to bite the economy, which is only happening now, as I said. But the second thing is, what is driving this expectation that interest rates are going to fall? Now, that's the kind of nonsense that you hear from the equity markets. They always want to persuade themselves that once rates go up, they're going to come straight down.
Isn't the bond market telling us that too?
Well, no, the bond market's been much more circumspect, because what bond markets want is, and this is the critical comment, they want real interest rates. Now, inflation is going to remain stubbornly high next year. It's not going to rise dramatically, at least we don't think so, but it's not going to fall straight back to 2%. It's probably going to stick about 3%, 2 to 3%, let's say, if we're optimistic. To get real interest rates, which is interest rates over the rate of inflation, that means that bond yields are going to remain somewhere in the region of 3.5 to 4.5%. So there's going to be little gains for bond markets next year. And I think that stock markets and their expectation that rates are going back to zero, they are fooling themselves. I want to know what they're smoking.
Well, let's talk about what the casualty of your view could be, because Europe, I mean, aside from the FTSE 100, has been a fabulous place to invest so far this year. Are you suggesting that you're not looking for that repeat performance?
No, I'm actually very concerned about Europe because I think the lagging effects are going to be particularly strong in terms of the way they damage European economies. Plus, of course, we started off this conversation talking about electoral cycles. In the UK next year, we're going to, at some stage, when the government loses heart and gives up and finally calls an election, then we might see a new government come in, a Labour government as opposed to the current Conservative government. And that may cause, perversely, something of a bounce for the UK until investors realise that nothing's really going to change. Any new government will remain as constrained as the current one in terms of what it can spend to reflate the economy. In Europe, I think there's a different political danger. First of all, we're seeing a definite move towards the right and a rise of populist politicians across Europe. Secondly, it looks as though we're going to see a shift in what's going to happen relative to Ukraine. Stalemate has been reached. We're talking about the possibility of will that force a deal next year, which is going to set Europe and Russia into a new Cold War. Now, does that mean that some European economies are going to look again to take cheap Russian energy, potentially creating a rift in Europe between NATO, the EU, and these countries that want cheap energy again? Now, that's a much bigger discussion than 2 minutes here, but that's certainly one of the risks I perceive next year, European global politics.
So where are you putting dollars to work in that cautious sort of market and environment? Where do you want to hide out or play defense?
Okay, so I've been pretty negative so far, but the reality is this is just another business cycle. It's slightly different because we're reversing what was a very inflated business cycle caused by very low interest rates, what we call zero interest rate policy and quantitative easing since the last global crisis. That's going to take longer to work its way out. But once that happens, I think we're going to see very strong growth. The question to ask, though, where is that growth going to come? Well, as always, it's going to be in fundamentally sound companies. But there are also these new areas. Now, everyone's been raving about AI. I'm not so convinced. I think it's got us ahead of itself to some extent. But there are other things that are going on in the global economy. Renewable energy, the boost that Biden created through the Inflation Reduction Act in the US. We're going to see similar things happen elsewhere around the globe. More and more renewable energy. Don't panic about COP going nowhere this year. There's going to be new technologies emerging outside digitization. Things like biotechnology, new ways to produce better foods and stuff. And these are all going to create growth stories. What we are going to see a diminution of next year is going to be some of the froth that has tended markets. And I think a good example of froth is hope over reality. I think we're seeing that just now in Bitcoin, which of course has gone from total irrelevance to suddenly being $42,000 or $43,000 again. The only thing I can ask is why?